Well, greetings to all my investment clients. My name is Walter Mazers, your wealth manager, CPA, tax advisor. As always, doing a weekly stock market recap as of January 9th, 2026, Friday, close of stock market. But before I get into the details of my weekly stock market recap, as always, disclosure statement. This video is not intended as investment advice or solicitation to buy or sell any securities, especially for anyone watching this video other than my clients. Please read the full disclosure if you want more information about myself, Walter Mazers, or Trinity Wealth Solutions. You can go to this website, brokercheck.finra.org. So that we got that out of the way, let's get into kind of a recap of economic news as of January 9th, Friday. There was a jobs report. So kind of in summary, job growth, employers added 50,000 jobs in December, below expectations and significantly slower than previous years, capping one of the weakest years for job growth in decades. So what does that mean? The economy is slowing down. More and more people are starting to lose their jobs. The unemployment rate, the rate unexpectedly slipped to 4.4 in December from a revised 4.5 in November. That unemployment rate is a little bit misleading. This is interesting how they count who is unemployed. If somebody has stopped working or dropped out of the employment market, meaning they stopped looking for a job, well, they consider them also, they don't count them anymore, which is kind of silly. So really the unemployment rate is, if you were to count those people who dropped off, much higher. Inflation is set to rise slightly in early 2026. Now, nobody knows for sure what inflation is going to do. With some analysts forecasting a tick up to 2.7. And again, the concern is about tariffs that may hit consumers. So tariffs is a one-time increase in pricing, so it's not a continuous. And this is what kind of drives me a little nuts, excuse the language. But inflation is always a monetary issue, meaning too much money chasing too few goods. We are not in that place right now. Definitely, there isn't too much money being created, and there is no shortage of goods or services. So typically, that's not an environment that you're going to have inflation. That doesn't mean inflation is always there. I mean, inflation is growing at about 2.5, 2.6 annual rate. So inflation never goes away. It just slows down. That's the big misconception. Yes, inflation for the prior 3 years during COVID, there was a significant increase. A cumulative inflation is, I think, over the last 3 years, well over 25%. Wages did not come close to keeping pace with inflation, and that's the problem. Costs of goods and services have increased. Yes, they've settled, they've tapered off, they're not going at a much higher pace, but people's earnings have not kept up with inflation, and that's the problem, really. Interest rates, what the Federal Reserve is going to do, there's many predictions. Some are saying they're going to hold in the new year, meaning the first in January. They may not lower interest rates. We shall wait and see. GDP growth, economic growth for 2026 is forecast as, I guess the word respectable, pace over 2%. Now, if we hit 2%, that's a slowdown. Remember, third in 2025, it was high as 4.3. 2% growth isn't robust, but it's not recessionary. But again, these are predictions and nobody knows for sure. Probabilities is the best way to put it. So that's kind of the economic recap. Is the economy slowing? Yes. Are we in a recession? Depending who you talk to. People kind of, as I mentioned, the K-shaped economy. People who are in, the top 10%, they're not going to be affected by a slowdown. But the people on the lower end of the spectrum of income are struggling, unfortunately. So with that, remember the consumer represents 70% of the economy. So if the consumer starts becoming concerned whether they're going to have a job, what are they going to do? They're going to cut back in spending. And that's how recessions eventually, or slowdowns, start. Okay, so let's go into the stock market. Now, I'm just looking what you're seeing on the chart. Remember, I'm always comparing different asset classes. TLT, which is long duration bonds. QQQ, which is technology. SPY is the broad market, and gold. As a quick reminder, my clients are invested in QQQ, SPY, and gold. So we're capturing a good portion of the upside of the stock market and precious metals. So sometimes I get not too many clients ask about, well, what about silver? It's been going gangbusters. That's too volatile. Yes, it's had a huge run up, but just as fast as it came up, it could dramatically correct. And if you look at the chart of silver for volatility, one day it could be down 10% and then be up another 10%. That's too volatile. It's too much of a small market in silver. And silver can be, because it is such a smaller market, pricing can move dramatically both up and down. Gold is a more consistent commodity. That's not going to blow us out of the water, on the downside or the upside, but it's been doing pretty well. So again, clients have exposure to gold, QQQ, SPY. So we have about, between all those asset classes, we have about 70% exposure to the market. So portfolios are doing pretty well beginning of the year. If we kind of look year to date, it's very short for 9 days. The markets, gold has done well, and we've captured pretty much a good part of that. We're not 100% invested in gold. And then, so it's still the best performing asset class if you're comparing to broad market or technology. If we're looking at SPY or the broad market, it's up about 1.6, and even long duration bonds have been heading up. So everything is, the momentum, the trend is still up for the stock market, and especially precious metals, specifically gold. Again, seasonality, the first 2 weeks of any beginning of the year is usually positive. What's going to happen later in the month or with the first quarter of 2026, you might as well flip a coin. Nobody can tell you with certainty that, hey, definitely the market is going to be heading up with no reset or pullback. So if we look at 1 year, again, the trend is up. Gold had a pullback last year, and now it's starting to head back up. Same thing with the broad market. There was a pullback, but it's now heading up. How far it's going to go? Our research company is right now positive. It's a positive trend. Momentum is still up, but with a lot of caution, because we are approaching that topping stage where everything is overpriced. Can it continue to go up? Yes. How far? But remember, the higher we go, the greater the probability of some kind of pullback. So at this point, clients' portfolios are doing very well. We're not overly exposed, and we're not taking tremendous risk. There's a nice balance. We have exposure to gold, and typically they go in opposite directions. If gold goes up, the market may go down. So it's a nice balance. So very comfortable with my clients' portfolios, where we're at. And if market conditions dictate, then I can react very quickly to those market conditions. Pretty much, I push a button through Schwab, gives me that ability to make very quick changes across the board for all my clients, or be completely out of the market literally within minutes. So just want to remind my clients, I do monitor portfolios every day. We get twice a day alerts or research on the stock market from our research company. That doesn't mean I'm going to be making changes, but they give us feedback. What are they thinking? What's the probability of which direction the market may go? So far, the market has been trending up, but we just have to be patient and see which direction ultimately, longer term, the market may be heading. So on that note, hopefully everybody had a great Christmas and New Year celebration, and now back to reality and back to work, and wishing everybody a great weekend. Weather is super, feels like spring, but temperatures will be unfortunately heading down over the weekend. So again, thank you for watching. If any of my clients have questions, or if they want to go over in greater detail about their portfolio, I'd be more than happy to talk to any of my clients. Call me directly on my cell, 586-873-8156. Last thing I just want to go through is long duration interest rates. And I've got a 30-year bond for 1 year, and it's just all over place. It's just trending, as we call it, in a range. There's no definite trend to interest rates going down. If we look at 5 years, again, the trend's been actually up. If we look at all years, there was a significant started, in 2014. This was definitely a trend down, and then we had COVID, and pretty much interest rates almost went down to zero. And then we had the reversal because of inflation. So we are still, at some point, we will be getting into long duration bonds. We're not there. Interest rates have not found a trend down. So until we see that definite trend, like such as here, then there's great potential in long duration bonds. So on that note, again, have a great weekend, and we will see you next week. Take care. Bye now.